This episode is sponsored by Raisin UK. Sign up today and make your money work harder with exclusive savings accounts. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Where do you invest when everything is expensive? Stock market valuations are stretched, gold is up 40% on a year ago, and Bitcoin has hit an all-time high.
With some analysts forecasting a lost decade for US stocks, is it time to look elsewhere? And in today's dumb question of the week, why is Warren Buffett holding so much cash? All right, let's get into it. So let's start with some cold hard facts. What have assets returned over the last 12 months? So I'm looking at it right now, and the S&P 500 is up 36%. And that's just the price, not including the dividends. Gold is up 38%. Bitcoin is up 80%. Now, I guess this is both a blessing and a curse. It's good for our portfolios, for everything we've had invested, but it makes us nervous, doesn't it, Roman?
Yeah, it's made me nervous, and I've certainly been thinking about taking some risk off the table, but I think that's probably a mistake because it could be that we go even higher. You can't really use these signals of stock market returns over recent months, recent years to predict what's going to happen in future. It's just a very unreliable forecasting method.
Is it the Gamblers Fallacy? We say, well, stocks have gone up so much month after month that the crash is coming. It has to.
Yeah, and it makes people nervous. I know that because many of the people I speak to are saying, yeah, I don't want to invest in this market because it looks overvalued, concentrated, and that makes them a little bit shy about putting money into the market. But of course, that's what you should do. You should, if you are earning and saving, put money into the market, usually as soon as you receive it.
And I think it's the run of repeated all-time highs that makes people nervous. Like month after month, we get, it's a new record. And now the S&P is at 6,000, which I guess is a kind of psychological milestone. It's a round number. But as we've talked about before, all-time highs aren't really that indicative of anything.
That's right. It's just a number. And if you think about a drifting upward index like the S&P, it's going to spend a lot of time pushing new all-time highs. So that's completely normal. What's unusual is for it not to be pushing all-time highs.
I saw that the S&P 500 has ended the month at an all-time high 26% of the time since 1950. 26% of all months are at all-time highs.
And this is what I mean by normal. You shouldn't really be surprised by this. And the amount of time it spends below the all-time high is usually very brief. The median time is around 60 days.
But you do get periods where you get a big crash and a long drawn-out recovery. That's what happened after the dot-com bubble imploded in the early 2000s. In real terms, I think the S&P didn't recover for 13 years.
That's right. That was one of the worst drawdown periods ever for the S&P. And it's worth mentioning that people who've lived through that crisis, the dot-com bubble and then the global financial crisis, are probably much more cautious than people who didn't. So people who are new to investing just see these incredible returns and expect them to continue. Whereas if you're an old-timer like me, then you get slightly nervous because it just feels like 2000 again.
It doesn't take much to make you nervous, Robin. I think.
I'm a very cautious investor. It's true.
But it has been an incredible bull market, hasn't it? Maybe one of the greatest of all time. So after the financial crisis in 2009, I think the S&P 500 bottomed at, was it 666, ominously?
That's what people say.
And now, as we say, it's at 6,000. I mean, you do the maths. Just over the last decade, the S&P 500 has posted a return of 13% per year. That's total return, including dividends. And what you can do actually is break down that return, can't you, into the contribution that comes from stocks growing their earnings, kind of better fundamentals, what's coming from dividends, and what's coming just from exuberance, the valuation multiple expanding.
So maybe the way to think about this is fundamentals and exuberance. So increased earnings account for about 55% of the increase, because the annualized earnings growth has been about 7% over this period. Income accounts for about 25%, so that makes sense. That's a fundamental driver. And then valuation expansion, which is exuberance, accounts for a fairly large 20% increase. Remember that can come and go as people get excited about the market and then not so excited.
So 10 years ago, the forward price to earnings multiple for the S&P was around 16 times. It's now around 22 times. And I think once you get much beyond where we are now, it does feel more bubbly.
Oh yeah, if you look at a plot of the forward price to earnings multiple for the S&P, it's pretty much where it was in the post-pandemic euphoria phase.
And where is this euphoria still coming from?
I think it's an ongoing narrative. So first of all, we had the metaverse, and then we had AI, and now we've got the Trump presidency, which is incoming. So it's a little bit like Keepy Uppy, where each blow has pushed the S&P 500 further up into the air. And what you've got to hand to the US is they're really good at coming up with these narratives to keep stock prices inflated.
But it's not the whole S&P really, is it? It's that handful of stocks we come back to again and again, whatever you want to call them. The Magnificent Seven, the big tech, the AI bubble stocks. They're the ones who've been really successful at growing their earnings, while at the same time promising such great future earnings growth from artificial intelligence that people have rewarded them with a very high multiple. And concentration in the market is extremely high right now.
So I think it pays to look at a bit more context historically to look at these returns. For example, if you look at the US, over about a century and a half, it's generated just under 10% per year nominal return. And that's total return, you reinvest the dividends. So a period when you get 30% returns is unsustainable.
That is what we've had over the last year, as we've said. And I think there was a recent forecast from analysts at Goldman Sachs, which worried people a bit, and I think captured this sort of idea that we shouldn't get used to high returns. So the headline coming out of their forecast was that they expect the S&P 500 to deliver a nominal total return of just 3% per year over the next decade, which would be one of the worst periods since 1930. They say it's the 7th percentile, so 93% of decades would have been better than that. And in real terms, so once you account for inflation, they think the S&P 500 is basically going to go nowhere, delivering just 1% per year real return.
And it wasn't just a number they pulled out of the air. This was based on their 5-factor model, which came up with this forecast. So let's just quickly run through what goes into the model. The first thing is obviously the valuations that you start with, and those are elevated. The second factor is how concentrated the stock market is, and of course, they're very concentrated at the moment. One of the other factors is corporate profitability, which is again pushing all-time highs. Now, not all of the factors are pushing downwards in the forecast. So 2 of them actually suggest that there could be further upside, and that's the probability of an economic contraction in the period ahead, and then finally interest rates, which are expected to fall. So 3 out of those factors are at all-time highs and suggesting that we're going to get weaker returns in future.
Now, I think the deciding factor in what's going to drive poor returns over the next decade, at least from Goldman's point of view, is the market concentration. They say that currently ranks basically at the highest level in 100 years. And they say if we excluded that variable, so if we took that out of the model and just looked at the other 4 factors, then the forecast would be 4 percentage points higher per year than the baseline. So rather than that 3% nominal return, we'd be talking about a 7% return. So market concentration is causing a lot of the doom and gloom here.
And as they say, the reason why concentration's a problem is that if you have huge expectations about future returns and future profit growth for a small handful of companies, it's very unlikely that they'll successively beat expectations for 5 years, 10 years and beyond.
Shall I quote Goldman here? They say, our historical analysis shows that it is extremely difficult for any firm to maintain high levels of sales growth and profit margins over sustained periods of time. The same issue plagues a highly concentrated index. As sales growth and profitability for the largest stocks in an index decelerate, earnings growth and therefore returns for the overall index will also decelerate. It seems like this is staring us all in the face, right? We know the market's concentrated. We know stocks like Nvidia have extremely high multiples, which are basically pricing in lightning speed profit growth over the next decade. And yet they're already extremely big companies. Surely it's going to be hard for them to deliver on that.
Not just that, I think. It's also a strategic weakness for the US right now, because if you were, say, for example, an adversarial economy, I'm just thinking of someone in the Far East, then you can see the concentration risk right now. And if you wanted to impose tariffs that would really hurt, what would you go for?
Won't be soybeans again, will it?
But you can see the vulnerability, right? The rest of the world can clearly see that the weakness of the US economy right now, and certainly its stock market, is the concentration in just that handful of companies. And if there is a trade war, then the retaliation will probably come in the form of blocking those profits in some way. And given that for the Magnificent Seven, about 45 to 50% of their revenue comes from outside the US, that could be a severe blow to their profitability. Currently, we're in a situation where margins are at pretty much all-time highs for those companies, and they're very profitable, earnings are growing very rapidly, and literally overnight we could go to a situation in which there's a dramatic cut in their profits. I mean, this is kind of a worst-case scenario. I don't think that'll necessarily happen.
Nice big tech company you got there. Would be a shame if someone fined the crap out of it. I mean, we've already seen some stuff a bit like that in Europe, haven't we? The Digital Markets Act and the fines they've put on companies like Google, and Apple being forced to pay its tax bill in Ireland of $13 billion, which the US isn't happy about. And I wonder if we'll see the Trump administration get a bit more activist and try and fight back against Europe.
But I think the point is that Europe is not toothless. It's a very large market, and presumably they could hurt America back. And this is what happened in the past with the Smoot-Hawley Act. This is what happens if you have really strict tariffs. There's no way those other people aren't going to retaliate in some way.
Yeah, if America slaps a 10 to 20% tariff on, let's say, German cars, as they're talking about, obviously the EU is going to hit back in some way. And they have tools to do so. And I think you're right that they will be very aware that these big tech companies make up a huge percentage of the US market. So if you look at it right now, the 10 largest constituents in the S&P 500 account for 36% of the total index. And they trade at a forward price to earnings ratio of 31 times earnings, whereas the rest of the index is more like 19 times. So that is a big vulnerability.
Now, there are various ways of measuring concentration. You can look, for example, as you just did, at the 10 largest stocks as a proportion of the total market cap of the index. That's at close to an all-time high of 36%. Now, that's not the actual measure that they've used in their model. The measure they've used is to look at the market cap of the largest stock, currently Nvidia, relative to the 75th percentile. So you sort all of the companies in the S&P 500 from largest to smallest, and the 125th company is the one that you compare to. And by that measure, it's even more concentrated. In fact, it looks very much like the aftermath of the crash in 1929, when concentration was roughly 36% again.
And if you look at the valuation of the top 10 stocks on a forward price to earnings basis versus the valuation of the rest of the index, that premium is at the highest level since the year 2000, right at the peak of the dot-com bubble. I mean, if you take Goldman at face value, their 3% annualized return forecast, if you believe that, alongside their forecast for a 10-year Treasury yield of around 4% and inflation of around 2.2%, they say that suggests the S&P 500 has a 72% probability of underperforming bonds over the next decade, a 33% probability of underperforming inflation, so negative real returns, and a 4% probability of delivering a negative absolute return, so being down even in nominal terms.
And many people find that staggering, given where we are now, coming off a period of incredible equity market returns, where bonds were just seen as an afterthought. Well, bonds are fashionable again, and can I just say I love that?
Yeah, but do you? 10-year yields have been rising in the run-up to the election, and since the election have picked up again, although they can't quite decide what they want to do, can they, these bonds? I think the problem really is that Trump has fat tails. He's unpredictable, and you never quite know what he's going to do. And that introduces a lot of uncertainty to these kind of forecasts.
But that's why something like a Treasury is probably a safe place to hide. Although, to be fair, he has talked about defaulting on US debt in the past. So that could be a cataclysmic event for US Treasuries as well.
That Goldman forecast where they say it's very likely that Treasuries will beat the stock market over the next 10 years. If you look back in history, that is very rare that happens. If you look at rolling 10-year periods since 1926, Treasuries have only beaten the stock market around 17% of the time.
Yeah, but it's very rare. And I think that's why it's also shocking when that's the forecast. So I'm not convinced that that's going to happen. I'm sure that there'll be something else that comes out of the bag, which essentially pushes US equity higher or pushes profits higher to justify the current levels of prices.
What do you think about their methodology, though, at Goldman Sachs? When you read through the paper, does it make sense? It's not just putting their finger in the air and guessing, is it? They have sort of put together a model which, when they run the back tests, seems to be predictive.
Yeah, not just that, but they actually looked in the past to see what the model would have forecasted and what actually happened and why it was different. So it's not just a cherry-picked model to generate sensationalist headlines. They've been careful about it. They've chosen their variables very carefully, I think, and looked to see what the problems are with the model and discuss those in the paper itself.
Although it did generate sensationalist headlines.
Yes, and it did very well for our YouTube video as well, it has to be said.
And it was nice because you could go, oh, it's doom and gloom, without it being your opinion. But you could still talk about it.
Yeah, I always love doing that.
What I also liked in their paper is they have been pretty fair with marking their own homework. So they made a 10-year forecast in 2012 and they made one in 2020. And they were both far too bearish, probably. Certainly the 2012 one was. So they forecast at the time an 8% annual return for the S&P 500. And in reality, the return was far higher between 2012 and 2022. And it was actually above the upper bound of their forecast. And again, they made a forecast in 2020, which was for 6% per year over the next decade. Obviously, we don't know if that was too bearish yet because we're not even halfway through the decade, but we're tracking way, way above that for now, at least. So why should we believe them this time?
But what we're talking about here is mean reversion. So it was fairly bearish in 2012, more bearish in 2019, and even more bearish in 2024 as valuations have crept higher over time. So what we're effectively saying is that there will be mean reversion, that we're not in a new normal where valuations are just much higher and concentration's okay.
They're certainly not the only one being bearish either. Vanguard's 10-year outlook is not much higher. And there are people who are even bigger bears. I'm thinking here of Jeremy Grantham and GMO, where they've given a 7-year asset class forecast. They did that at the end of September. And for US large caps, they reckon minus 5.7% real return per year for the next 7 years. I mean, that would be disastrous if that happened.
Yeah, I think the Youngs refer to that as boom.
And here we've been focusing on the US stock market. Not everywhere looks so expensive. But the thing to say is if you're a global stock market investor, the lion's share of your money is in the US market, probably something like 60% if you're market cap weighted. So you should care about what's going to happen to the US.
This episode is sponsored by Raisin UK, the free, easy-to-use online savings platform. Access FSCS-protected savings accounts with a single login and watch your money grow. What's more, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft. Now, we've talked about US stocks rallying a lot, but of course it's not just about stocks. If you look across other asset classes, there are other things which have been rallying very hard. For example, gold is up about 38% over the last year, an incredible rally for gold. And if you look at something like Bitcoin, which some people compare to gold, not myself, I have to say, that's up by 80% over the last 12 months. It is still reacting very much like a leveraged version of NASDAQ. So when the NASDAQ index goes up, so does Bitcoin, and this is no exception.
But gold doesn't react like a leveraged version of the Nasdaq. Why is gold up almost 40% at the same time as stocks have rallied? Is that unusual?
I think part of it is that interest rates are now falling, so the Fed's pretty much at the end of its cycle. Plus there's been central bank buying, although that's kind of tailed off now. But I think it's also a sign that people aren't fully convinced that this rally is going to continue. Maybe it's a kind of hedge in case things start to turn around.
How is gold correlated to the stock market typically? Or does it just do its own thing and pay no mind to what the S&P is doing?
Over the long term, it's not very correlated. Over shorter periods, so if you look at, say, 90-day rolling periods, it flips positive and negative. So it certainly has value in the sense that if there's a very, very, very sharp fall in equity markets, gold often holds its value. Not always, but usually.
Do you think it would this time? Let's say we woke up tomorrow and the S&P began a crash which fell, 50% in 6 months or something. Would you expect gold to still rally from here, given how much it's already rallied?
I think it wouldn't fall as much. I think the fact that it has rallied so hard makes it more vulnerable. And probably it would fall about 25% based on a very simple model that forecasts based on the strength of the dollar, inflation, and real interest rates.
I guess it would depend what caused the stock market crash, right? If it was a big geopolitical blow-up and war in Taiwan or something, then gold will probably do pretty well. If it's a financial crisis and interest rates suddenly have to get cut to zero again because there was a big leverage bubble that blew up which no one know about, then I guess gold would probably do pretty well there too, wouldn't it?
Yeah, I just think that if it was something which was a slow deflation of the bubble, so instead of an overnight crash and terror, it was just a revaluation to sane levels, then I think gold wouldn't be quite as useful because it's also overvalued based on these kind of very simple models.
I guess if inflation resurged and rates had to go higher, that probably wouldn't be good for gold typically.
Which is a scenario which is fairly likely according to economic forecasts.
Because people think about gold as an inflation hedge, but gold shouldn't really like higher interest rates, given that it pays no income.
Exactly. A wasting asset and higher treasury yields are just not a good combination.
And moving on to Bitcoin, you're pretty convinced that is just tracking US tech companies, basically. It's a proxy for that.
But also people have talked about deregulation in crypto alongside Trump's reforms. So that's what he said he's going to do, and that could push prices upwards.
I mean, he said a lot of stuff. He said that he's going to bring in a national Bitcoin reserve, like Fort Knox for Bitcoin.
Yeah, a very odd policy. And I think that could push up the price if the US were to buy huge amounts of Bitcoin, of course. But whether they'll actually go through with that, I'm not convinced.
I don't think they will. But then, Trump's fat tails. Who knows? So if we're saying US large caps look expensive, gold, you can't exactly say it's expensive, but it's rallied a lot. Bitcoin, who knows what it's worth, but it's rallied a lot. What about other assets?
So high yield credit, junk bonds in the US have also rallied. It's not been such a blistering rally, but they've certainly increased in value. Now, that's partly because of the economic outlook improving, but spreads are now super tight, so I don't think there's a huge amount of upside for them from here. But now we're getting an all-in yield, which is quite attractive. And certainly Howard Marks expects that the risk premium for high yield will be comparable to stocks in the years ahead. And he knows what he's talking about. He's a high yield credit guy.
But would you buy when spreads are so tight? Why wouldn't you just buy Treasuries or investment grade credit?
Yeah, at the moment you could. You're not getting much additional yield for taking that credit risk. I'd prefer to wait until there's an accident and then pile into high yield. But at the moment, I agree. I don't think there's much reason to buy high yield.
And just bonds generally, there's definitely an upside risk to inflation, especially now with Trump back in, probably going to run higher deficits, probably going to cut taxes, probably not going to cut spending too much. And if inflation does pick up, then rates will go up and bonds will go down. So it's not like they're a safe play really at the moment either.
And don't forget that Jerome Powell will end his current role as Fed chair in May of 2026, and Trump's not going to reappoint him. He'll put someone into the position who'll also favour low interest rates. Combined with his inflationary policies, that doesn't look great for inflation in the US. Now, the interesting thing is property, because if interest rates are higher, that's not going to be great for property, which usually relies on leverage for upside. So maybe a big property developer in the White House, maybe he'll pull a rabbit out of a hat to help the real estate market. But if interest rates do go up, I don't think that looks good for real estate either, in the US certainly.
So I've been a bit surprised that the property market is at all-time highs in the US, even though mortgage rates have gone up to 7%. Like, you'd have thought there'd have been some correction. There has been a little correction in real terms, but not too much. Same in the UK.
Yeah, as long as real wages continue to grow fairly strongly, which is the case in the UK and in the US, I think that kind of counteracts the very high interest rates, because people, at least some people, can afford it. But a diminishing group of people who've already got property wealth. So it's not going to be a blistering housing market rally. That's certainly true, I think.
And in terms of other forms of property, if we look at commercial property, well, we've been expecting a shakeout there for a while. They can sort of delay the impact of rate rises, but it's not easy to find tenants for those buildings these days, and they are being sold at distressed prices when they do come on the market. So we've said US stocks, expensive, gold, Bitcoin, credit, property, bonds. None of that looks particularly attractive. What does that leave us with? What are we in? Just cash waiting? I know we're not. We're still in the market, but if you're nervous.
Well, cash rates are coming down because we're at the end of this rate hiking cycle. But it may be the case that based on Trump's policy, certainly in the US, that we're going to see the Fed having to raise interest rates, whoever's in the Fed chair. And that means that cash will become more attractive, assuming that inflation doesn't spike too much.
I mean, who knows what's going to happen to interest rates, right? If you believe the Fed, I think they're forecasting it to come down to around 3% over the long run.
Yeah, 2.9 is the central case for the dot plots right now, at least in September.
That was pre-Trump, I guess. So maybe a bit higher. We'll see. But the big question here is, as investors, what should we do about all this? It's not easy, is it, to invest when almost everything looks expensive?
Well, they have a suggestion, Goldman. When they publish their paper, they look at the forecast for the equal weighted version of the S&P 500. So if you're not aware of it, this has equal weightings for every stock in the S&P 500, such that the smaller caps at the bottom end of the market cap table for the S&P, the one at the bottom of the table, has a 30 times multiplier relative to the market cap weighting. What Goldman expects is that these small caps will outperform because largely they're value stocks. Alternatively, you could do that yourself by buying an S&P 600 tracker or a Russell 2000 tracker in order to boost the small cap component of your index.
Then you're going for even smaller companies, aren't you? Because they're not even in the S&P 500.
Yeah, which comes with its own risks. If there is a recession, for example, they'll probably suffer more. Or you could go for a value index, in which case you'll probably also have a small cap tilt.
These are all ways of trying to say, I don't want so much Nvidia, Apple, Google, Microsoft.
Yeah.
Do you think it makes sense to do that?
I'm not doing it, I have to say. And the reason for that is I just like simplicity. And there has to be a huge push to move me out of that position of simplicity. But having read this paper, but also seeing where valuations are, I am tempted to do a bit of diversification at this point.
Okay, so let me ask you when that temptation will be realized. So we said that at the moment, the top 10 components in the S&P 500 account for 36% of the index, and they trade at a forward PE of 31 times. How high would concentration have to get, or how high would that multiple for those Magnificent Seven companies have to get for you to say, well, that's rich enough for me, I'm diversifying?
Well, we're kind of there already. We're already at valuations which are close to the post-pandemic euphoria phase. And I don't think there's a lot further that valuations can go. But, as I say, it'll take a lot to move me out of just one index fund.
Well, that's what I'm asking. Like, how much is a lot? Like, when would it come where you go, I just got to go with my rational maths brain now?
I think if I was being rational about it, I'd probably already be doing something. And I am kind of doing something in my fund portfolio. I've got the small caps. I've got a UK tilt in my fund portfolio. But that's just 10% of my investments. Plus, I've got quite a lot of dry powder. I've got quite a lot in money market funds right now. So about 12% overall.
I mean, this kind of runs counter to what we usually say, which is that you can't time markets. There's no really good indicators of when the market might fall or unwind or rotate in some way. And you just got to hang on through thick and thin. So is that always coming with a caveat of unless things get too extreme?
Yeah, well, I just think at this point, I don't really need the money because PensionCraft is generating an income. So in that sense, I could just leave it and not worry too much. So it is becoming a much more long-term portfolio for me. When I was just starting out, I was heavily into bonds and very safe investments. Now I've dialed up the risk. I'm kind of comfortable with that. But nobody likes to lose money, right? You always like to think, oh, I can second guess things. I'm sure I can't, though.
I'd be more nervous if I was about to retire right now and had a lot in stocks.
Yeah, if you depend on the money, I'd be cautious. That's certainly true.
So the remedy you think in terms of stocks would be dial down the Magnificent Seven somehow. But is there also a case for further cross-asset diversification? If most things look expensive, then take a bit of everything and hopefully not everything crashes at the same time.
Well, look, there's always the choice of cash, and cash returns are still pretty good. They're falling as central banks cut rates, but now we're starting to see a world in which inflation's looking stickier and the rate cuts are coming more slowly than people expected. So one option is always to de-risk, and that's what some people do just before retirement. Often, it makes sense to do that.
I think now is certainly the time to think, how would I feel if stocks crashed 50%? Would I be able to sleep at night? Would I be able to live with myself? Would I be able to explain it to my partner without falling out? Like, the time to think about that is now, because the risk of a crash is never particularly high, but it is probably higher now than when valuations are lower.
Yeah, that's right. It does have a slight effect. And I think that's a fair point. The time to plan is now when you can sell the stocks at a very high level.
Now, I'm not saying you should sell your stocks. I'm not selling my stocks. I'm young enough to think I'm going to hang on and I'm not going to sell if the market has a dump. We'll see if that's true, if it happens. Certainly, I know that I didn't sell in the sharp COVID crash of 2020 when stocks were down more than 30% in a matter of weeks. I know that I didn't sell in 2022, although the pound helped us out there, made us feel a bit better that the pound weakened. So if those events hadn't happened, then I'd be a bit more unsure about my psychology, but I'm pretty confident that I can hang on, so I'm not doing anything. If I wasn't confident that I could hang on in a 50% crash, then I would be doing something right now.
Yeah, visualize how you'd feel. And that's a fairly good indicator of whether you should take some risk off the table. And remember, as always, this isn't advice. This is about working out what's best for you. And you should always do your own research. And part of that is probing your own psychology.
Absolutely, because I think there can't really be advice in a general sense anyway, because it's not really about stocks and other assets. We know that you can't really time the market and it's best to just hang on. But that's only true if you can hang on and not sell when stocks crash. And we don't know that. That depends on you. And it depends on your belief that the market would eventually recover if it did fall, which it has in the past.
But not all the forecasts are bearish right now. For example, if you want a ray of sunshine, you can always turn to Ed Yardeni. Thank you for the graphs, Ed. Who's forecasting that this is the roaring 20s. People will look back on this period as an incredible period, bull period for stocks, and that tech stocks are just getting started. These are companies which will continue to have very high margins, which will be more productive than old companies. And furthermore, he expects this rally to continue, largely on the back of that productivity growth in these tech stocks.
It was interesting. There is a caveat in that Goldman report where they say, when we do the back tests of this model, it is not particularly predictive at periods where you have an economic paradigm shift or rapid technological change. Let's hope we are in that situation, right? And that we're looking here in 10 years and we're like, wow, we did another 10% per year in returns.
Yeah, let's hope. Now, I mentioned that gold model where we were looking at the fair price of gold. If you want access to that and all sorts of other goodies, plus the ability to discuss valuations right now and what other people are doing, just go to our website, pensioncraft.com/membership, to learn about joining our community.
Okay, today's dumb question of the week is, why is Warren Buffett holding so much cash? Now, I think it's fair to say you need to understand Berkshire Hathaway, Buffett's business, to know that he always holds quite a lot of cash because one of their biggest businesses is Geico, which is an insurer. If there's a hurricane that blows through America, like we've seen, then they're potentially on the hook to have to pay out a lot of money in claims. So he always holds a fair amount of cash, but right now he's holding an exceptional amount of cash.
And that's largely because of some disposals he's made recently. For example, he sold some Apple.
Some Apple. He sold 2/3 of his stake in just over a year.
And he had a sizable stake. So a big cut, but it's still his largest holding as of Q3 2024. It still makes up about a quarter of his portfolio, just under.
I mean, it's interesting that Berkshire has been a net seller of stocks for the last 8 quarters, and they've sold more than $160 billion worth of stocks in 2 years. And they've not bought much in that period either. So year to date, they've just bought $5.8 billion of stocks. So big net disposals here. That's where all the cash is coming from.
But do you think this is the equivalent, the portfolio equivalent of clearing out your loft so that your kids don't have to do it after you die? Just clearing out the decks so that they've got choices about what to do?
Yeah, maybe. So obviously Charlie Munger died last year. Buffett is in his late 90s, so you'd guess he's not going to be there too much longer. But I think there might be more to it. Buffett famously built up a big cash position before the 2007-2008 drawdown. So it is slightly ominous that he's doing it again. And cash is now 28% of Berkshire's assets. That's the highest ever level. They have $325 billion of cash and equivalents and have earned nearly $10 billion in interest on that pile over the last 12 months. I mean, that's one reason, right? He sees interest rates have been 5% or whatever over the last year, and he's happy to take that.
One of the other things he mentioned in interviews was that he expects capital gains tax to increase in future. So that's one of the reasons why he's doing the disposals now rather than later.
That seems unlikely now the election's gone the way it did, though. But those are the justifications he's given. You're right. He's definitely not saying, this is because I think the market's going to crash. I'm building up some dry powder. He would never say that.
But he's not seeing huge opportunities, that's clear. And when valuations are this high, you can understand why.
Implicitly, he even believes Berkshire is overvalued. So he's stopped all stock buybacks for the first time since 2018.
And it is 9th in the market cap table for the S&P 500 last time I checked.
I guess Buffett just backs his judgment, though, doesn't he? He says, I can't see anything worth buying, therefore I'm not going to buy. There's a quote where he says, I don't mind at all, under the current conditions, building the cash position. I think when I look at the alternative of what's available in equity markets, and I look at the composition of what's going on in the world, we find cash quite attractive.
So there you are. We were talking about the alternatives in this kind of environment. He's clearly not putting it into Bitcoin.
I would love it if he did. Do you think he could be deposed as the CEO and chair?
He could go full Michael Saylor, yeah.
Maybe there's something in what you said, though, about giving Greg Abel or whoever takes over enough dry powder to do what they want with the company and not inherit too many legacy holdings or have the balance sheet tied up too tightly. Because remember, it takes a long time for Berkshire to dispose of these holdings. If he could sell his entire Apple stake overnight, maybe he'd have done so, but he'd have crashed the price of Apple, right? Because he held, what was it, like 8 or 9% of the entire company?
Yeah, he can't move quickly. But if you are a value investor and markets are high, then this is the natural thing to do. Your stocks currently are not value stocks, and they will be eventually. There will be new opportunities around the corner, and just selling them when they're at new highs makes sense, particularly Apple.
Especially if you think the future for Apple is not as good as the past, which is probably going to be the case. He's already generated $100 billion in profits from what he's sold so far of that Apple stake. It's a hugely successful investment. But will he get another cycle? Probably not.
No, and I think he's just clearing the decks for the next generation because those opportunities will come along. He's seen it so many times before, and I just think he's clearing the way.
Thank you for joining us for Many Happy Returns. do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.